All right, we are starting with the very first area of financial management F9, that is basic investment appraisal, right? So one stage in the capital budgeting process is investment appraisal, right? And so firstly, you need to know that the features of investment appraisal, right? So features of investment appraisal, we need to know, and what are the features of the investment appraisal. Number one, it is the assessment of level of expected returns. Level of expected returns earned for the level of expenditure made. And number two, estimate future cost and benefits over project life. These are the features of investment appraisal. Now, the two basic appraisal techniques which we're gonna discuss in this lesson: basic investment appraisal techniques, which we gonna discuss are: number one, return on capital employed (ROCE). Number two, payback technique, right? So the most sophisticated methods of investment appraisal will be detailed in our upcoming lessons. Now, firstly, we will discuss the ROCE, return on capital employed, right? ROCE, also known as accounting rate of return, and the formula to compute ROCE is equal to average annual profits, average annual profits, profit before interest tax, divided by initial capital cost, multiply by 100. Okay. Or now, how you will compute? Sorry for this. Sorry. Okay. So average investment can be calculated as follows: average investment, capital investment is equal to average capital investment is equal to initial investment plus scrap value divided by 2, right? So in the exam, you should use the initial capital cost unless you are told otherwise. However, the ROCE calculation based on the average capital investment is the method most commonly asked in the exam, right? And it will be here, it will be made clear to you that what to use in the exam question. Now, the decision rule. As far as the decision rule is concerned, what you need to do, if the expected ROCE for the investment is greater than the target or hurdle rates which are decided by the management, then the project should be accepted, right? Now, what we will do, we will do the example. We will do the example regarding it. Okay, here is the example, and it's saying a project involves the immediate purchase of an item of plant costing 110,000. It would generate annual cash flows of 24,400 for 5 years. Starting in year one, the plant purchase would have a scrap value of $10,000 in 5 years. When the project terminates, depreciation is on straight line basis. We have to determine the project using initial capital cost and average capital investment. Okay, so here it is. What we will do. So, firstly, annual cash flows need to be taken for profit before depreciation. So average annual depreciation firstly. Average annual depreciation 110,000 minus 10,000 divided by 5 is $20,000. Average annual profit is equal to 24,400 minus 20,000. What we will get? We will get $4,400. Now, firstly, we have to compute it using initial cost. ROCE is equal to average annual profit divided by initial capital cost multiply by 100%. We will get 4,400 divided by 110,000 multiply by 100%. We will get 4%. Right now, if we have to compute it using average capital investment, how we will do it? Let me show you. Using average capital investment, average annual profits are same as before. So that gonna be how much? 4,400. Average book value of assets is equal to 110,000 plus 10,000 divided by 2. We will get $60,000. ROCE now average annual profit divided by average book value of profit, average book value of assets. multiply by 100%. What we will get $4,400 divided by 60,000 into 100. We will get 7.33%. Cool. That's it. I hope you get it. Get the example. Let's move on. Now here is another example related to ROCE, and it's saying a project requires initial investment of $800,000 and then earns net cash flows as follows. In year one, it will earn 100,000. Then in year two, it will earn 200,000, and in year three, it will earn 400,000. In year four, again, it will earn 300,000, and then year five, again 300,000. In year six, 200,000, and 150,000 in year seven. In addition, at the end of the 7-year project, the assets initially purchased will be sold for $100,000. Determine the project ROCE using initial capital cost and average capital investment. So this uses profits rather than cash flows, as you can see, and average annual inflows. Let us compute 100 plus 200, it's plus 400 plus 300 plus 300 plus 200 and 150. So average inflows, average annual inflows is equal to $1,750,000,000, and we will divide it by 7 years. We will get $250,000. Average annual depreciation, $800,000. Okay, average annual depreciation is equal to, as you can see, 800,000 minus 100,000, the scrap value we noticed in the scenario above, divided by total years, which is 7 years. We will get 100,000, right? So net $700,000 is being written off as depreciation over these 7 years. Now, average annual profit is equal to 250,000 minus 100,000. What we will get $150,000. The average capital invested is 800,000 plus 100,000 divided by 2. We will get 450,000. Now, as per the part A, we have to calculate the ROCE with initial capital cost. So A part, average annual profit divided by initial capital cost multiply by 100 is $150,000 divided by $800,000 multiply by 100 is 18.75%. With B part, average capital investment, average annual profit, divided by average capital investment, multiply by 100, we will get $150,000. It is $150,000 divided by $450,000 multiplied by 100. We will get 33.33%. That's how you need to do it. And I hope you get it till here. Right. So, so far so good. Now let us discuss the advantages and disadvantages of ROCE. Firstly, let us look at the advantages. What are the advantages? Number one, it is simple to calculate, simple to compute, and it links with other accounting measures. Disadvantages, no account is taken of project life. Two, no account is taken of timing of cash flow. I hope it is clear till here. Then other disadvantages are it may ignore working capital. Number four, it does not measure absolute gain. Number five, there is no definitive investment signal. Right. So I hope you get it till here. And let's move ahead. And now, in let us discuss about the accounting profits and cash flows. In capital investment appraisal, it is more appropriate to evaluate future cash flows than accounting profits. Why so? Number one, because number one, profits cannot be spent. Number two, profits are subjective, they are subjective because there are various issues while computing the profits, and cash is required to pay dividend. Pay dividends. Okay, so these are the reasons for between account. These are the you know the worst thing between cash flows and profits. Cash flows are a better measure of suitability of capital investment because of these three reasons. Right. Now we will discuss about the cash flows and relevant costs. For all methods of investment appraisal, with the exception of ROC only, relevant cash flows should be considered. And what are the relevant cash flows? Number one, they are the cash flows which has to be incurred or in the future. Number two, the incremental cash flows, and what are the incremental cash flows? Those cash flows will be incurred in the increasing way, and those cash flows which are the cash based, that means uh, depreciation and amortization are irrelevant. Now, which cash flows to ignore? Which cash flows to ignore? Very simple. You have to ignore number one, sunk cost. The sunk cost which has been incurred in the past. The committed cost, the cost which you has already committed about. Number three, non-cash items. Number four, allocated costs. Okay, these are the costs which are already, has been incurred, already been allocated to something. And then we have payback technique to discuss, payback method of appraisal. So the payback period is the time a project will take to pay a project will take to pay back the money, spent on it. It is based on expected cash flows. And provides a measure of liquidity. And provides a measure of liquidity. Okay. What is the decision rule over here? Only select projects which pay back within the specified time period. Number two, choose between options on the basis of the fastest Payback. How to compute? What's the formula of payback period? Payback period is equal to initial investment divided by annual cash flow. Sorry. Okay. Now let us do the examples related to it. And here is the example. So as you can see the example, an expenditure of $2 million is expected to generate net cash flows of $500,000 for the next 7 years. And the requirement is, what is the payback period for the project? Okay, so let us do it. Payback uh, is is equal to $1.8 million divided by $350,000, and we will get 5.1429 years. So 0.1429 per year multiply by 12 months, we will get 1.7 months, which we will round it off to 2 months. Get it? So we can say that 5.1 year, or we can also say 5 years, 2 months, 2 months, right? And here what we assume that the cash flows occur evenly throughout the year, right? So far so good. Now what we'll do, we will do one more example. Hang on. All right, before we move to other example, let us do this example once again, because I just computed wrongly, and sorry for that, but we will do it again. So what it's saying simply that an expenditure of 2 million is expected to generate net cash flows of 500,000 for the next 7 years. What is the payback period for the project? So simple, very simple. What we will say, payback period is equal to 2 million divided by 500,000, and it's 4 years. Now we will do other example. So actually, this is the example which I solved earlier at wrong place. And once again, I apologize for that. So the question is, a project will involve spending $1.8 million. Now annual cash flows from the project would be $350,000. What is the expected payback period? Now see, what we will do simply, payback is equal to 1.8 million divided by annual cash flows 350,000. What we will get, 5.1429. So that means 5 years. Right now for this 1.1429 multiply by 12 months, we will get 1.7 months. We will round it off to 2, right? And therefore the answer can be stated as either 5.1 year, or you can say 5 years, 2 months, right? Assuming cash flows occur evenly throughout the year. Uh, Now let us move ahead in it, and now we will look at that what to do when uneven cash we will when there is uneven annual cash flows. So, in practice, in real world, cash flows from a project are unlikely to be constant. Where cash flows are uneven, payback need to be calculated by working out the cumulative cash flow over the life of the project, right? So, where cash flows are uneven, payback is calculated by working out cumulative cash flow over the life of project. And how we will do that? Again, for it, we have a example. And let us do that. So guys, here it is an example in front of you. As you can see, a project is expected to have the following cash flows in year zero. It is 1900 investment. In year one, we'll get 300. In year two, we will get 500. In year three, 600. Year four, 800. Year five, 500. What is the expected payback period? We have to compute, right? So simply now you can see over here that okay, let me keep the example in front of you like this. Now, year, cash flow, and cumulative cash flow. Year zero, 1900. It's 1900. Year one, we'll get positive 300. Now we will be in negative 1600. In year two, we'll get 500. Now we will be negative 1100. In year three, 600. Now it will be negative 500. In year four, we'll get 800. And now this time we will be 300 positive. And in year five, we will get 500. So we will get 800, we will be 800 positive. So in the table above, you can see that cumulative cash flows for the project today, right in brackets, those are negative, and then we get in positive. From year in year four, we get to positive. So the payback is between the payback is between year three and year four. This is during year four, right? It is during somewhere between year four. This is the point at which the cumulative cash flow changes from being negative to positive. If we assume constant rate of cash flow throughout the year, we would estimate that payback will be 3 years plus 500 divided by 800. So it will be between 3 years and then negative 500 to sorry 500. We can't take divided by negative. So 500 divided by 800 of year four. So this is a cumulative cash flow is minus 500 at the start of the year, and the year four cash would be 800. So in this case, 500 divided by 800, we will get 0.625. So it will be therefore the payback is 3.625. That means 3 years. And now 0.625. 0.625 multiply by 12, we will get 7.5 months. So we can say 7.5 months. So we can say 3 years, 8 months, right? I hope you get it. And for the sake of practice, we will do one more example. Let's go for it. All right, and here is the example. Calculate the payback period in years and months for the following project: year 0, 3100, year 1, 1000, year 2, 900, year 3, 800, year 4, 500, year 5, 500, and the solution will be now let us solve it. So what we will do, I hope you can do this with me as well. Uh, in year 0, again, year cash flow and cumulative cash flow. So year 0, 3100, and it is 3100 again. In year 1, 1000, it will be 2100 negative this time. In year 2, 900, so this will be 1200 negative this time. Year 3, 800, and in year 3, 800, it will be negative 400 this time. In year 4, 500, and this will be 100 positive. And in year 5 again it's 500 and 600 positive. So payback is between year 3 and year 4. In other words, during year 4, right? So if we assume a constant rate of cash flows throughout the year, we could estimate the payback will be 3 years plus 3 years plus 400 divided by, yeah, 400 divided by 500. Uh, sorry, 400 divided by 500. So 400 divided by 500 of year 4, which is 3.8 years. 3.8 years. So zero point 0.8 multiplied by 12 is equal to 10 months. So 10 months. So that's gonna be 3 years, 10 months. That's it. I hope you get it. And let's move ahead to the advantages and disadvantages. What are the advantages? It is simple. Number 2, it is useful in certain situation. Like in rapidly changing technology and improving investment conditions. It favors quick returns. and it uses cash flows, not accounting profit. So these are the advantages. Now, what are the disadvantages? It ignores returns after the payback period. Two, it ignores timings of cash flows. It is subjective. It ignores project profitability. Right. These are the disadvantages, and I hope you get it till here. And here, our this chapter, this area ends, and I'll see you in the next session.